Welcome to Module 7. Module 7 is my entry criteria and how I get in and out of the trades. This is the last module, you'll be pleased to hear. If you're watching this module first because you've looked at the thumbnails on the course and you've decided to skip ahead to the end, absolutely fine. Just bear in mind a lot of the stuff I'm going to talk about will make no sense to you, go straight over your head. But I understand, I've done courses before, I understand you want to get to the nitty-gritty bit, which is the system, the strategy, how to get in and out and make money out of the market. And this is what this is. But if you've sat through modules 1 to 6 and got to this one at the end, well done. You've done the course in the right order, and everything I'm going to say now is going to make complete sense to you. So let's have a look at what this is about. Rules. We've got some rules around here. Now, this is basically the module which is going to give you those signals and criteria to get in and out of the market. But before we do that, we need to look at another important area of trading, which is a bit less interesting, which is journaling. Okay, it's paperwork. Now, there's a lot of traders out there that don't do journaling. I personally don't know any of my friends and people that I trade with that don't journal. They all do, I do. But there are a few people out there that can get away with not looking at their trades and not learning and just basically crack it. But in my experience, 99% of traders that are successful do this religiously on a daily basis. I do this every week on a Friday without fail. Okay, so on a Friday I'll go into my charts. I'll go into all my historical trades for the week. I'll put them all on a chart. I'll have a look at every single one of them and I will see how they performed. At the end of the month I do the same experiment again, or not an experiment, the same process again, but I look at how those trades played out over the longer term. Okay, there's lots of ways of doing journaling. The way I do it is basically by visualizing the trades on a chart, which I'm going to show you in a second. But you don't have to keep fancy spreadsheets and complicated pie charts. There's good software out there like Edgewonk, which will track your trades and give you all sorts of data. You can set up a spreadsheet where you can put the entry price, the exit price, the instrument, the profits you made, the pips, what condition the indicators were in. There's all sorts of stuff you can do to journal, but the way I'm going to show you is very, very simple, very, very quick, and I find it's the most visual way of journaling, and you can go over it anytime you like and see loads and loads of trades play out, which gives you lots of confidence in yourself. So there's two things that journaling will show you, which are key to developing your confidence in your ability and in your systems. Okay, first thing is they show you whether or not you got in at a good point and whether or not your signal or your system that you were using to get into the trade was accurate. The second thing they'll show you is whether you got out too early and left loads of money on the table. Now, this second thing is key to becoming a successful trader. Okay, when we get into a trade and the trade hits our take profit, or we get out of the trade by whatever means and we have finished that trade, we never look at it again. Okay, so what journaling will do in the way that I'm going to show you is it will show you what happened after your trade was taken. All right, which is very important, because if you had a profit target and you got scared and got out of that trade before it hit your target, that's absolutely fine. As long as you made some decent money on it, banked some pips and made our P&L green, that's a good thing. That's what we want to do. But if you'd have let that trade run for another day, it would have hit your TP and possibly bagged you double the profit it did. But you won't know that unless you go back and look at that trade, all right, and see what happened to that trade. So let's have a look at how we do this. So I've got my MT4 up here, and I have a template which is basically called C trades, I call it, and it's just a simple template with knocked back candles on it. Right, so there's the color scheme that I use for this particular template. So it's just got an RSI on it and the candlesticks. Now you can put on here, if you want, the order block breaker indicator, all the other indicators. If you want to have a much more detailed view of where everything is, then that's absolutely fine. I kind of know where everything is now automatically, so I don't need them, but you can put as many indicators on here as you like. But the key to this is, what we're going to do is go into our terminal. Every Friday in the afternoon, late afternoon on a Friday, we're going to go through and we're going to drag every single trade we've taken onto the charts and look at them one by one. So you can sort it by symbol. Okay, so you can go in there. Let's have a look at a custom period. I mean, I'm going to have to go back to, let's go back to last Monday and assume I'm doing this on a Friday. Okay, so what I can do is sort by symbol and drag every single one of the trades onto my chart so I can see what happens. So we've got Aussie dollar, Swiss trades here. We've got 1, 2, 3, 4. That's a pending, that's a pending. Okay, so we drag those 4 trades onto the chart and we can see now exactly what happened to those trades. So my idea, my plan in this case was to go short here on a signal, probably on an M15 breaker or something. Not quite sure what the actual entry was on that one, but so we can see where we had our entry, we can see where we put our take profit levels for each of our trades, and if we were using stops, like trailing stops for example, we can see where those trailing stops would have been. All right. So in this particular case, you can see it's pretty obvious what I'm targeting. There's this big propulsion candle here, and my TP on these trades is set around about this area here, which is nicely in the middle of this propulsion candle. So I took the trades, price moved against me. This is my second entry. Remember, I planned my trade. So my initial entry was here. I planned if price went against me to get into my second trade up here. Okay. Price came back down. I decided to take a profit as it was approaching here on that one because I probably wanted to bank some profit for the day. I may have needed it for something else. And then price continued to move down and I got out on these trades here. Reason I would have got out on these is because we were getting into Friday and I wanted to get out and not hold over the weekend. Okay. Took another little short there on Friday, which was a scalp. Didn't go my way. I thought maybe if we pull back a little bit and break these, what I was looking for was a stop hunt at this particular level here, come back down, get down to the target that I initially planned. Didn't happen, so I closed it out at loss. Okay, but I can see what happened, how this trade played out over a period of time. Let's go and have a look at something else. So what else we've got in here? Got a nice Swiss yen. So we've got a Swiss yen trade. There's another bit of a Swiss yen there. That's a pending. Okay, so let's have a look at this one. Initial entry was here, nicely over the 80 level on the TDR or the RSI. So there would have been a reason why I would have taken this trade here. Maybe if I look left, I might have seen a level that we were approaching. Possibly somewhere around there. I don't know. Let's have a look where we got in. Okay, so we pulled back up into this area of resistance, which is probably where I was looking at an area that made sense to me to trade from, which I'm going to talk about in a second. Okay, we got into the trade, went against me, had a big propulsion candle move. Okay, so just as I got into this, we had some news coming out, and this is probably the vaccine news actually. So went against me immediately. Now my planned second entry was taken up here. Okay, price pulled back into this propulsion gap here. I took profit on the second entry, took a loss on the first entry, came out with an overall profit. Okay, so you see how journaling helps by allowing you to see on the charts visually what's happening with your trades. So every Friday, just go into your MT4 and drag your trades onto the chart. When you've dragged your trades onto the chart, literally just right click, save picture as, select active chart, click OK, and that will save a PNG file, an image, to your computer, to your desktop or somewhere, and just keep them in a folder. And you can go back over these at any time you like in the future. At the end of the month, if you do this exercise, you'll be able to see what happens, not on a week by week basis, but you'll be able to see what would have happened if you'd have held that trade for even longer, for into the month. All right. So it's a very important exercise, and I want you all to do it. It will make a massive difference to your trading. Look how much money I left on the table here. I got out here and I took a loss on that one. If I'd have left it for another 4 or 5 hours, I'd have taken a much bigger, about 50% more profit out of that trade, and I'd have taken a profit out of that one, not a loss. Massive difference. If I'd have left it all week, took it on Friday, look at all that money I left on the table. All that. Tons. Absolutely tons. 85 pips are left on the table. But I wouldn't know that unless I'd done this exercise. Okay? So very important, journaling. Make a note on your notepad. I must journal. Do it religiously every Friday. If you've got Outlook or you've got some kind of calendar on your phone, stick a calendar entry in for 5 o'clock on a Friday afternoon. Do my journaling. And just go into MT4. It takes literally 10 minutes to drag all your trades for the week onto your chart and quickly save them. And then look at them over the weekend or whenever you see fit. Okay, rule number 1. This is the rules. So I've got rules for every entry that I get into. My number 1 rule for every entry is look left. Okay, very, very simple. Always look left whenever you are looking to get into any trade. The reason you need to look left is because we can't look right. We're at the hard right edge of our chart. We have no idea what is going to happen, but we do know what has happened in the past. And hopefully in the modules that you've done, you've seen the importance of past levels and what the importance they play in our trading is, how we should look to take trades from logical levels, logical areas, okay, support and resistance areas, levels that can be stop hunted by the banks. Okay, we need to know where they are. So whenever we get into a trade, we look left. All right. So let's have a look at a chart. Okay. Here we are on Aussie dollar yen. Okay. Whenever you get an indicator alert, so for example, we've got a breaker, a bearish breaker appear here. What I want you to do is look left. Okay. Now there's 2 reasons we're looking left when we get this signal. Let me just move this forward a little bit so that it's roughly where we would see this actually happening. Okay, so that's where we get our breaker. So we know for a fact that we're looking for certain criteria to be met in the market with our indicator and with levels, right? So we're looking for ideally a stop hunt to have happened or some kind of level in the past that makes sense for price to be turning at now when we get a breaker. We're also looking for good targets that price will potentially reach for. So we need to have a target in place and we need to have confluence in our trade that gives us the confidence to get into the market. So when we receive this breaker here and we look left, what do we see? We see a shooting star happening, which is stop hunting a level. All right. We also see that price has put in 2 nice big propulsion candles here. So there's a good chance that this area here is likely to be a target in the future. All right. So by looking left, we're looking at historical data that tells us where price is likely to go. Now you can see that this area here has acted as a nice level of resistance. It's come up and it's hit this, it's come back down, it's come up and it hit it again, it came back down, it pushed through it, slightly rejected and then pushed on through again. Okay, so we know this is a strong support level. So if we're taking this trade now, by looking left it gives us 2 things. One, we've got a valid stop hunt. We can also see a nice lot of divergence. Our TDI or RSI is above the 68 level, so we've got confluence with our trade and our breaker. And we can see that there's a good area here to be targeting. So if we were getting in a trade here, we would enter on this candle possibly. If you're using a stop, you'd put your stop up there and your TP would be down here. Okay. If you're not trading with a stop, you'd put your first entry here and you'd put a second pending entry up here, assuming price is going to come up and maybe stop hunt this again before dropping. Right, but looking left shows us exactly where we're going to possibly play out if we're wrong and where we're going to possibly go to if we're right. Those 2 things you can only identify by looking left on your chart. Another thing to do when you look left is to jump out of a zoom level. Okay, so jump out 1 zoom level and have a look to the left and see if there's anything else obvious on your chart that could indicate either trouble or a potential another confluence to add to your trade idea. So in this case, we've got our breaker here, and we can see if we look left, where this breaker is happening is an area of previous support. So you could have a little alarm bell ringing there thinking, okay, do I want to be selling into support? Maybe, maybe not. If I'm a cautious trader, what I might do is wait for price to push through here to confirm that that breaker is holding, and then come back and retest the breaker area or the peak formation candle that's here before pushing back down. Okay, so in this case you could have waited for that to push through, come back, and then push back down again. Price often will come back and retest breakers. Okay, but you wouldn't have seen that if you had not have zoomed out and looked left. Okay, another thing you can do is just jump up a time frame. Have a look left when you've jumped up a time frame. Another good example here, you can see this level of support here. Look else, what else it was. Beautiful area of resistance. Again, again, again. Okay? So we know this is a very, very strong area. So it's possibly an area that we may not want to be taking a short into. But look what happened. Price came up, bang, what happened again here? It's rejected off of this support. Incredibly strong area. But the only way we can see this is by looking to the left, okay? And also when we're looking left, what it also does is help us plan potential pending order entries in the future, okay? Up here and up here. Where might price come and stop hunt if I'm wrong on this trade? All right? So that's why we look left. Every time we enter a trade, without fail, we look left. We're looking for either a reason to get in or a reason not to get in. Okay? Very, very important. You'll hear me say this a lot in the live room. If anybody comes up with any ideas or I come up with an idea, I'm always going to be zooming out and looking left to see whether or not there's a good valid reason to get into this trade or not. Okay? Rule number 2. TDI stroke RSI, whichever you want to choose, is king. It is my backbone. I never ever take a trade without the TDI or the RSI being in the right position. It's the core to my entire existence as a trader. Okay, the RSI, as I've explained when we looked at the indicator section, is a fantastic tool for measuring the strength of a currency pair, and it tells you when exhaustion levels are likely to be met. Okay, so most of the time I'm looking for reversals of some kind when I take a trade. Okay, so I'm looking at a reversal at a previous peak, or I'm looking at a reversal on a pullback in a trend. Okay, whichever way you look at it, I'm looking for a reversal in price, which can also be measured with the RSI or the TDI. Okay, remember in module 4 we used the simulator, and I used the RSI on its own to take entries, and we did that little experiment where I took 4 or 5 trades and basically got 100% strike rate. That was just based on the RSI alone, literally the RSI getting over a level or under a level. I took 5 trades, I had a 100% strike rate. How many times can you say you've tried a new system and it's got a 100% strike rate? And that was just an RSI, okay? But the RSI had a 100% strike rate because of my entry strategy, not because of the RSI. But breakers happen when there is a reversal, okay? So we are reversal traders, even when we're trading in a trend. So when we see a breaker, we're looking at a possible shift in market structure, a break in market structure. If the RSI confirms that, okay, so if I've got a bullish breaker and the RSI is either down at the 32 level, it's just coming out of the 32 level, that is a big confirmation for me. Okay, remember why we've got indicators. We have a signal indicator. We have an indicator to tell us what the market conditions are. Okay, and that's our RSI. So when we are trading baskets or grids, based on the fact that price will oscillate and give us an opportunity to get in and out of the market if we're wrong, we need an indicator to show us that oscillation. All right, that is what the RSI is doing in my case. Okay, We must get in when the odds are in our favour, and we can see that the oscillation is where it needs to be for our entry. So if we see a breaker, okay, and the RSI is hovering around the 50 level, I just completely ignore it. Okay, that isn't a good trade because the RSI is telling me that price is somewhere in the middle. It hasn't moved to an extreme. It's not exhausted. It's just trading in its normal way. I'm looking for price to have moved to a logical area that makes sense for me to take a trade from, and the RSI is one thing that tells me when it gets there. Okay, so logical sense, trades at logical sense and extremes is what we're looking for. I'm just going to quickly show you the RSI and what I mean. So we've got a breaker happened here, okay, on the Aussie dollar yen on the H4. Now this breaker has happened at this point here, so I'm just going to mark it on the chart. That's where the breaker happened, on this candle here. If we scroll down and look at the RSI, look where the RSI is. It's sitting in the 50 level. Now remember, I want to take trades at extremes. If I look left on this trade, is there any reason why I should be taking a short here? Possibly, because we could look at this as maybe a level that has just been stop hunted. It's come back up and it's touched a level of previous support and resistance here. Okay, so that might be a good breaker that I want to take, but the RSI is sitting in the middle. So for me personally, even though this breaker played out and made a nice profit, that wouldn't have been a trade that I would have taken. This breaker down here, though, would, because we are at a level of extreme. Okay, price has come down and swept an area, a big area of support that hasn't been tested. There's nothing else to the left of us, look, to say this isn't a good area to take a trade from. And RSI, when it got down to this peak formation low candle, which is this one here, was extended beyond the 32 level. Okay, so that's why I say that price is either below when I get a signal to get in, or it's just come out of an area of interest at the level at the 32 level. Okay, same up here. We've got a breaker on this candle here. Okay, look where the RSI has just been. It's just been up over the 68 level. Okay, this peak formation candle here has also got divergence on it, and it's come back over and swept this level here. So I would be taking a short trade here. Moved down nicely, would have made me 72 pips. In this case, we've got a target here which still hasn't been traded in, so I suspect Aussie dollar yen is a good short at the moment. Tempted to take this actually, but so we got this level here which it hasn't traded down to. You see, price just came down to this level here and hasn't touched this part of the candle, so we've got an inefficiency here which still needs to be filled. My suspicion is we're trading back up, retesting this area, this peak formation candle here, almost to the pip, retesting this breaker before pushing back down to this level here. So if you got in right now on this trade, probably looking at something like a 70-80 pip reward. Okay, so that's why I use the RSI. Look at this level here. RSI came down, 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 way, way, way below the 20 level here. Really, really, really strong push down. Got a breaker on that candle there. Price has come violently out from underneath the 32 level. Brilliant trade. Nothing to the left to say don't take me. In fact, my target would be this level here, because that is the next level of support resistance that I can see on the chart. So we'd be taking a trade up to this level here, which would be 86 pips. Okay, and if it moved against me, then I would be looking left to see where's the next level I'm going to get out at. Now you can see I've just scrolled out of my chart a little bit. Look left. Okay, exactly tweezer bottoms, a few pips beyond that low, stop hunt. Okay, RSI. All right, so that's why the RSI is king, and I never take a trade without it. We're going to look at the exact entry criteria for each of the strategies that I use in a minute, but basically the rule is the RSI needs to be either below the 32, above the 68, or has just exited the 32 or the 68 levels after performing a stop hunt with other confluence. All right, so that's why the RSI is king. Rule number 3 for every entry: make sure you have an achievable and a realistic target. There's no use entering a trade and setting a target with a 10-to-1 risk-reward ratio unless you are happy to wait for it and you know that price is going to go there and it's got a logical reason to go to that level. Okay, your target is the next logical place that price is likely to go to, not a specific risk-reward level. Unless you want to carry on using fixed stops, of course, then yeah, just make sure your risk-reward level is positive. But just because you set a 3-to-1 risk-reward ratio on that trade doesn't mean that it's going to achieve it. Okay, price is going to move back to the next area. It's going to find either stops or resistance where it's going to potentially bounce from. Okay, so we're going to choose one of these areas as our target. Okay, number 1, if we are range bound, we are going to pick somewhere near, but not the actual top of the other side of the range. Okay, so what I mean by that is, let's say we've got a nice range here, okay, and we take a trade here. If this was a range bound market, which it kind of is, moved up to there, came back down to here, so we've bounced off of this bottom of the range here. If I was taking this trade here, and I wanted to target the other side of the range, I would set a target somewhere up this area, but I would not go for the top. I would pick an area that is somewhere around the 75% level of where the top of this range I think it would potentially go. Okay, price, if it's in a trend, will tend to move up, down, up, big retracement, up, down, up, break above this high, big retracement, and these big retracements quite often will not be 100% of the previous push up. Okay, so if you're going to set a target at the opposite side of a range, don't set it right at the top. Set it somewhere realistic, about 3/4 of the way. Look for a bit of an area of balance, an area of consolidation where you've seen price chopping around. Quite possibly it's going to get back up into this area and chop around a bit more. It may not get through it. This is a big area of resistance that price has got to break through. So you see in this case, there you go, so it's pushed up to around about 50% of that move. If you're a fib trader now, you'd be going, yeah, look, it bounced off the 50% every time. And I'll show you another 100 times where it doesn't. Yeah, then it pushed back down here and it pushed up again. Now we may well be looking at a reversal pullback. Now it didn't get all the way to the top of this range, did it? Didn't get all the way up there again. So don't set it at the opposite side. Set it a realistic level that you think you can achieve. I mean, if we're looking at this trade, if we were taking a stop loss on it, we'd put 80 pip stop. 160 would be a 2-to-1. I mean, that's plenty, isn't it? 240 would be a 3-to-1 up here. So you could get a 3-to-1 out of that easily if you wanted to trade with stops and take profits. All right. So that's the range bound targets. My personal favorite is an inefficiency, a propulsion candle. It's an area that price is obviously going to get back to. We know that. And if you've spent time in the simulator when we looked at that section of the course, you'll have seen these propulsion candles get filled all the time. It's not necessarily going to happen today, this week. It might take a couple of weeks. It depends what time frame you're trading on. If you're trading 1 minute charts, it might take an hour or two for that propulsion candle to get filled, but it will get filled. Okay. I prefer H1 and H4 as my targets, just because that's the time frame that I like to spend most of my time and analysis in. But we know all about propulsion candles. We've looked at them. We've got some examples here. You know, so there's a propulsion candle there. It pushed down, only traded in a downward direction, didn't trade back up to fill this gap. So we chopped around for a bit and then we traded up. This propulsion candle was then put in. Price traded to here. It moved up, and then it came back down and filled in that gap, moved off again, put in another big propulsion candle, and now we're trading back down to fill this in again. They always get filled in. Okay, this one here got filled in. Yeah, this one here got filled in. Okay, this one here got filled in. Propulsion candles are the best targets you will ever see. When I see a news item come out, okay, and I see these big candles being put in and price pushing away from where it was and leaving these big candles behind, I'm rubbing my hands. I'm just looking for any opportunity I can to get in the opposite direction of where price is going right now, because I know it's coming back there, and I've got so much confidence in those that I will just keep piling in and piling in and piling in as price is moving further and further and further against me, because I know at some point that thing's coming down, and when it comes down, it's going to come down hard. Okay, look at this. 1, 2, 3, 4 down candles to try and fill this in. They were pushing hard. They needed to make this efficient. It wasn't efficient going up. They needed to rebalance their books. Okay, propulsion candles are the best thing you can spot on any chart. Okay, if you see them, you trade to them. Just look for any opportunity to get back to one. This came in here, I'd have just gone, yep, I'm going long right now. Taking a long in there, came back against me, I'll take another long. I don't care, because I know it's coming back to this level here. Look what it did, bang. Pushed up so hard to get to this level, it left another propulsion candle for me. So this first bearish opportunity I get up here, taking a short, bang, filled in. Okay, propulsion candles are king. Pay attention to them. Every time you see them, you know we're coming back. All right. Another area you can target is a support and resistance level. Any recent strong move will leave price extended a long way away from its previous support or resistance. Okay, so when we're looking at a trend will, or a buy cycle or sell cycle, it will tend to move in waves, as we know. Okay, so let me just get my drawing tools up quickly and I'll show you what I mean. So we know that price moves in waves. So we have our move up and then down, up and then down, up and then down. Okay, what it's doing is coming back to areas of support and resistance. Okay, trades back to them. So let's have a look at that on a chart. So price has made a sharp move down here, and I've got a breaker. So when I enter my trade at this level here, get on that candle there, I'm going to be looking left and looking for potential target opportunities. Now, there's no really amazing propulsion candles. There's one up there I can see that is a good target, and as you can see, obviously that got hit. That's been traded back into, so that level there and that level there traded back into. This one here is a good target, but look at this. This is a previous area where price has come back down, been supported and moved off. All right. It just so happens to coincide with another area it tried to test as well. So price came down to here, this level, oops, sorry, didn't want to draw that. This level here, okay. This to me is a great area of support and resistance moving back up. So this is an area of support previously, and now it's an area of resistance. So when price comes down here and I take my trade here, my first target will be this candle's wick here. Okay, so this is a resistance area I'm expecting price to have a reaction at. Look what happened. Hit it twice, pulled back away again. Okay, came down to my entry position and then pushed back through it. Right, so look to the left. Again, I can't stress this enough. Look left. The market leaves footprints and clues everywhere as to where it's going to be going. And all you've got to do every time you think I'm going to get into a trade now is look left. Can you see somewhere it's going to go? Yeah, that's your target. And it is really as simple as that. You've heard the phrase buy low, sell high. I think I might have mentioned this in the previous module, but it is so true. Look at our RSI. When it gets down the bottom, what do? We buy when it's low. What do we do when it moves up? We look for an area of support or resistance or propulsion candle, and when it gets up there, we expect it to switch the other way. We sell high. We buy low, we get out high. We sell high, we get out low. Trading is that simple, really is that simple. But the reason we can make it that simple is because we have targets. We know where price is going to head to. All right. So a realistic and achievable target for every trade is a given. Okay. So that's rule number 3. You have to have a target, and you have to be confident the price is going to reach that target. All right. And every entry you get into after your first one, if it is a failure, is going to have the same target. Unless price moves so far away from you and so far against you that you now see more propulsion candles as targets, then yeah, you might want to switch your target. But you know it's going to come back at some point. So if you trade small and let the drawdown just work in your favor, you can ride these waves back up to these targets. But you've got to have the targets there. You've got to know when you get into the market where price is going to be moving to. Okay, so those are your targets. Every time you see a trade opportunity, you must have a target. Are they far enough away for you to warrant taking this trade? If yes, get in. Simple as that. If you're wrong, plan when you're going to get in for the next entry. Rule number 4 is the confluence list. Okay, these are just additional confluences to help me to get into a trade. I need reasons to get into a trade. I've got rules, so I know that when I get a trade idea, I'm going to look left. I know that I'm going to have the RSI in the right level or coming out of the right level. And I know I've got a good target to aim for. So those 3 rules have been met. Now, rule number 4 is basically me just looking for additional reasons to get into this trade. Okay, think of it like a 3-star or a 4-star or a 5-star trade. Okay, rule number 1 gives me 1 star. Looking left, have I got an obvious area that price is turning at? Yep, that's 1 star. Star number 2 is my RSI is in the right level or come out of the right level. Okay, so that's a 2-star trade. 3-star, have I got a good target? Yep, got a lovely big propulsion candle to aim for, so that's a 3-star trade. These extra confluences just add more stars to my trade idea, if you like. So look at it in that way. You're building a case. Think of it like a lawyer. You're building a case to take a trade, and these are just giving you those additional confluences to give you confidence to get in. Okay, so there's 3 confluences, if you like, that fall in line with rule 1, which is basically looking left. All right, when we're looking left, what are we doing? We're looking to see if price is reacting at a previous area of support and resistance, or we're looking to see if price has just swept a recent high, i.e. performed a stop hunt. That's why we're looking to the left. So the first 3 areas of confluence we're going to look for are stop hunt of recent highs or lows. So looking at your chart, is there somewhere on the left there that's obvious where we've had a stop hunt, price has moved up, taken the stops and now moving back down from a recent high or a low. A stop hunt of yesterday's high or yesterday's low. So if we're trading on small time frames like M5 and M15, the yesterday's high, yesterday's low levels are incredibly important. So if one of those has been swept, that's an additional confluence. And a stop hunt of last week's high and last week's low. So this is when you're trading on slightly higher time frames like H1 and on H4. You'll probably use last week's highs and lows as good levels to have swept as well. All right, so let's have a quick look on the chart. We'll look for some examples of these. So obviously looking left is a very simple one. So if I'm looking left on the chart here, okay, there's a level. All right, so this is a level here. Okay, so that's just a level, right, that has been recently swept. So the stop hunt of a recent high or recent low. That is a recent high. Price has come up here, moved above it, pulled back down. Obvious stop hunt of a recent high. Yeah. Stop hunt of yesterday's high and yesterday's low. So a good example of that, if we switch down to M15, we'll be able to find one of these easily. So we've got our yesterday's high, yesterday's low line here. All right. Obvious stop hunt of yesterday's high, move back down. obvious stop hunt above yesterday's high, push back down. Okay, obvious stop hunt below, sorry, that's not yesterday's low, obvious stop hunt there below the Asian low, push back up. All right, so this is yesterday's low, lovely stop hunt below yesterday's low, push back up. You can use yesterday's low, you can use the Asian highs as well. I mean, this is an Asian high, lovely stop hunt at the Asian highs. I haven't put that on the chart, but yesterday's high and low will quite often coincide with the Asian sessions and the London sessions highs and lows as well. So you can use the stop hunts of yesterday's high and low as well as Asian levels as well on the charts. So those are obviously prime examples of yesterday's highs and lows being swept. All right, have I just had one of these? Yeah, brilliant. Got a breaker here, for example. Got a breaker, got an alert. Stop hunted yesterday's low, get in. This one's a bit too far away. You wouldn't take a trade here because it's, you know, it's way too far extended already. But yeah, so that's yesterday's high and yesterday's low rule. Stop hunt of last week's high and last week's low. Let's have a look on the chart here. We'll flick out to H4 for this one. All right. So last week's high and low sweep. So this would be a good example here. This last week's high. Obviously we're in this week now, so that's actually signifying that. But imagine that was, say, last week's high back here. When we've had a sweep like this or a sweep like this of last week's high, so this breaker here, for example, if that was last week's high line, we've made a beautiful stop hunt of it, got a breaker, that's an additional confluence for me to get in. All right. So looking left, I mean, these are all pretty much the same as each other. We're looking for highs and we're looking for lows that have obviously been swept for stops before they take price off in another direction. Tdi Divergence, okay, rule number 2 confluence. Rule number 2 is our RSI or our TDI has to be at the right level or coming out of the right level. Divergence, as I explained in the RSI and TDI video, is basically these lines here. So we've got price making a low and making a new low, but the TDI or the RSI has not made a new low here. So divergence, if we get this, it's a good signal that there is more, in this case, buying pressure or selling pressure than the TDI or the RSI is signaling. Okay, so it's just another confluence to add. If we get a breaker and we see it's come out of the 32 level and we've got divergence, that's just another tick to add to our trade idea. M or W pattern confirmations. I haven't covered M and W patterns very much. There's lots of information on the internet about M and W patterns. They're a very, very well traded pattern, a little bit like price action candles. M and W patterns, a lot of people trade these religiously. So let me just quickly show you what an M and W is and what's actually happening when an M and W happens. So what an M and W pattern is basically where price makes a high, pulls back down, makes a low, makes another high, and pulls back down before continuing on its direction. Same with a W. Okay, it forms a sort of W pattern, and then the idea, the concept is that price will push off in the other direction. There's different types of M's and W's. Okay, so you can have an M which forms equal highs. Okay. You can have an M which forms unequal highs, like that. And you can have an M where it's the other way around. Okay, so it comes back down and makes that sort of pattern. So they're uneven highs. Okay, and the same obviously for W's. And all that's happening here is the market is being brought up to a particular level. Okay, typically this will be a stop hunt of another level over here somewhere. All right, and then what they're doing here in this case is they're putting price back down, pushing back up again. Okay, enticing traders who saw this breakout and pull back, they're enticing them again to come into their long positions. All right, so if I'm a retail trader, I've seen a breakout, and obviously retail traders love to trade breakouts. Most fatal mistake you can make, but anyway, you see a breakout, you see a pullback. As a breakout trader now, I'm like, wow, excellent, we've got a breakout and price is pushing back up in that direction. So I missed this one, So what I'm going to do is I'm going to get in here with a long trade. Okay. What they're doing is they're showing you that price is probably going to go back up, enticing you in to put a long trade in. You're putting your stop here, and all they're doing is saying, no, I'm not actually going to take that out, I'm going the other way. Okay, so they're enticing you into a long trade, knowing that you'll put a stop under here, so they can come back down and take all your stops out. Okay, an M is equal M is basically a stop hunt and another stop hunt. Okay, and what typically happens when they make this double top is they will widen the spread when they get to the second top here rather, and by widening the spread, what they're doing is they're taking out stops of anybody that's put their stop exactly on that high. Okay, and this is a very simple one. There's your stop hunt, bring it back down, push up again, take out the stops of everybody that got short there, who put a stop up there, come and take their stops out again, and then pull price back down in the opposite direction. Okay, so that's why it's a very well traded pattern. It's an obvious pattern, and it signifies a lot, a stop hunt of some shape or form happening. Whether they hunt that stop once or hunt that stop twice, doesn't matter, and how they hunt it is irrelevant. The fact is, when you see an M or a W pattern in the market, pay attention, because it's a very, very strong reversal signal. Okay, let's have a look, and we'll find some M's and W's. M15 is a great place to spot these. So there's an obvious one there. Okay, that's an M, badly drawn M, but it's an M. Okay, so that signifies an M. Basically, that's the unequal M that I was talking about. So they've come up, they've stop hunted the high, they've pulled price back down, they've pushed off again from this previous high. Okay, so breakout traders will have seen that happen, gone, we've got a breakout. Oh no, it's pulled back. It's pulled back to an area of support and it's bouncing. So what happens here is I get in here on this candle and go long, and what you do as a market maker is you pull it back down. So I've put my stop under here, you've taken my stop out on the way down. All right, so that's an M pattern. Let's look for some others. There'll be others we can spot. Yesterday's highs and lows are great places to spot M and W patterns. Now you're going to see M and W patterns happening and playing out all the time. Okay, that is an M. Yeah, you can spot these all over the place. Okay, there's an M there. Okay, these aren't M and W patterns you want to be taking. M and W patterns have to happen where there is a stop hunt. All right, here is one that I can see here. Okay, yesterday's high, difficult one to spot, but you have got an M in there. All right, one quick tip for you on M and W patterns: if you're having trouble spotting them, switch your chart over to a line chart. I haven't got a line chart on this one. Hang on, let me just switch. Go into my properties, line graph, and make that black. Okay, switching over to a line chart can often help you see M's a lot clearer. Look at that one there, beautiful M there. All right, so it's a way of helping you to spot M's and W's is switching over to your line chart. So if you're unsure if there's a good M pattern there, you can always switch over to your line chart to help you spot these. Okay, not particularly clear that one, but you know, you can see these little M's. Sometimes they're tiny, but the important thing with M and W's is you're looking for them at previous support and resistance and stop hunt areas. Okay, so it's got to be an area it's done the M above. Now it might move up and do it up here, which is fine, or it might just sweep the level. Okay, but that's what an M and a W is, and that's what's happening in the market when we're looking for them. All right, so they just add an extra level of confluence to our trade idea. Peak formation high and peak formation low levels being extended. So if I get a breaker, all right, and I can see it's got a lovely stop hunt, the RSI is in a good position, and I look at my dashboard, and my dashboard says also that there is an extension of peak formation high or peak formation low. For example, if I get a signal on Euro Swiss to go and have a look for a breaker, and I see here that we're also extended, that's just another reason for me to get in, because if peak formation high and low has been extended more than 3 times ADR away, it's just another reason for me to get into a trade. And the same with ADR levels, okay? So if the ADR level is also extended, okay, if I've got an ADR alert when I get my trade idea, or I see that price has moved outside of the ADR and pulled back in, it's just another confluence for me to get in, another reason for me to get into a trade, okay? So that's rule 4, confluence. I want more confluence added to my trade. Now there are some times when I won't take a trade because I don't see confluence. There are other times where I see a trade and there is no confluence, but the first 3 rules have been met and I think, wow, those are absolutely perfect conditions, and I will just get in anyway. But what you will tend to find is that one of these confluences will be there. If you've looked left, you have probably seen a stop hunt. If you've had a strong move, your TDI will probably, or your RSI will probably be over a level and will have put in a divergence, okay? If you've had a strong move, there's a good chance that a peak formation high or low or an ADR level has already been extended. So you will quite often find that one of these will always be in your trade idea when you see it anyway. All right. So that's rule 4. Rule number 5 is whatever time frame you plan to trade on, you stick to it. Okay. So when I get alerts, and more on that in a second, I perform an analysis of my charts. My entire trading day revolves around my dashboard and my alerts. Okay, so I only pay attention to alerts. I'm not watching charts 24/7. Although they're on my screens, I'm not staring at them. I'm normally watching Netflix or doing something else, because trading's boring until you get an alert, and then it becomes exciting. So if my dashboard does an alert, I'm not trading. Okay. So the process of looking for an entry is triggered by an alert on my dashboard. If I see an M15 breaker, I may take a short scalp on that M15 chart, but on doing analysis, I may think a higher time frame offers a better target for an idea to play out. So what I mean by that is, when I get a M15 breaker alert on my dashboard, I go to the M15 chart and I have a look at that trade idea. I'll look left, I'll see if there's a good target on M15. And I may not be able to see to the left a nice easy stop hunt. So what I'll do is I'll switch out onto H1 or onto H4, and I'll have a look at a higher time frame. And when I look at that higher time frame, I might spot that the RSI is in a perfect position. We've just had a lovely stop hunt of a recent high, and there's an M pattern on the H1 chart. Now, if I take a trade based on that M15 breaker, but I enter because the reason for my trade is on H1, I manage that trade and I stick to that trade on H1, okay? So I will be entering additional entries behind my trade if my trade goes wrong and goes against me on the H1 chart, and I'll be setting my target on the H1 chart. And it's crucial that you don't suddenly go into a trade with an H1 plan and switch down to M15 to then manage that trade, because M15 you're going to get lots of chop up and down, and you're going to get out of that trade, you're going to get scared. Stick on the time frame that you enter that trade on. Okay, if you enter on M5, your plan is on M5, you trade on M5. Okay, and you will have different trades running probably on different time frames, and that's fine. I scalp on M5 and I scalp a bit on M15. I swing trade on H1 and H4. Okay, they're different types of trades. My swings are going to last for multiple days, sometimes into weeks. My scalps are going to last for a few hours, and if they go wrong, I may turn them into a swing trade. Okay, so whatever time frame you take a trade on, and this is an important rule, you stick to that time frame and you manage that trade on that time frame. You will find over time that you will become more comfortable on certain time frames than others, and we've covered this in previous module. Picking your time frame is a key element to becoming successful. If you're no good at M5 and M15, you try scalping with the order blocks on M15 and it doesn't work, you're not an M15 trader. Switch up. The higher the time frame, the less chop, the more solid the signals will become, and the better you will get with consistency on a higher time frame. So I stick to H1 and H4. They're my go-to timeframes. I trade most of my trades off of the H1 chart and do most of my analysis on the H1 chart. But that's because I can see market structure a lot more clearly on H1 than I can any other time frame. So it makes more sense for me to just trade as much as I can on H1 because I'm successful at it, I'm good at it, so I stick to it. Okay, but the key for this rule is if you look at a chart and you see a trade which looks better on another time frame than on the one you initially got the signal on, take the trade on that time frame and stick to that time frame. That trade plays out on that time frame and no other. Okay, so that's rule 5. Okay, so I just want to talk quickly now about how I spot my entries. I've covered this briefly in one of the previous slides, but alerts are the key to my success. Okay, the dashboard that I have developed has columns on it to alert me to conditions that I am interested in. All right, so I am interested in breakers predominantly because breakers signal market shifts in market structure. So I want to know when a potential shift in market structure appears on the time frames that I'm interested in trading, which for me is M15, H1, H4, and was daily. I don't trade that so much anymore. Okay, without alerts, what I found myself was I was watching charts all the time. And what I would do is be looking at these charts and I'd see a big price action move and then I'd go, look, there's an M pattern there. I'd take a trade and it would be wrong because I'm aimlessly watching charts. And there's that saying, the devil makes work for idle hands. Yeah, if you're sitting there watching charts and you're not in a trade and you're looking to get into a trade, you'll take a trade because you want to be in the market. And that's a fatal mistake because it makes you overtrade. So by having an alert dashboard and just acting on alerts, you will get into the market only when a potential good market condition presents itself. Okay, so alerts are the key to the way that I trade. They're the key to my strategies, they're key to my entries, and they're key to keep me out of the market. It's basically the hub of my whole trading life. So there's 4 alerts that I concentrate on, and if these alerts aren't pinging at me, I'm not really doing any analysis. So the alerts that I have are ADR, peak formation high, peak formation low, breakers, and RSI. Now this 4th alert, RSI, I've got another dashboard which I have built and I'm using at the moment, but I'm going to integrate the RSI alerts into the main breaker trader, the order block breaker dashboard. All right. So by the time you're watching this, hopefully my new version of the dashboard will be out, and that will have RSI columns in it as well. So you'll be able to monitor the main time frame RSI positions and get alert on RSI positions within the breaker dashboard as well. Okay, so there'll be more information on that soon if it's not already out and you're watching this early on when it's been released. There's a new version of the dash coming, but otherwise you've probably seen the new version of the dash anyway. So every alert I get, I basically go and look at the chart and I search for a reason to get in. I'm looking for enough confluence to take a trade entry. So when I get my dashboard up on the screen, okay, let's say I've got an M15 breaker alert on the pound New Zealand. I'll go and have a look at the pound New Zealand and I will see if there is something to the left that looks good. Is the RSI in a good position? Has it just come out of a good position? Is there a good target if I was to get into this trade? Are there additional confluences? If not, then probably not going to get in. I'll flick up to a higher time frame, have a quick look at H1, see if it's in a level that I'm interested in. If not, shut the chart. That analysis, for me, will take me 5, 10, 15 seconds to do. I can instantly look at a chart and go, nah, not interested. And that's it. So that's all I do. I sit here and I wait for my alerts to ping at me and say, go and have a look at this chart. And that literally is what trading is. Go and have a look at this chart. Do you think you want to get in? Yeah, brilliant, get in. And another thing, there you go, an alert just come up now. M15 CAD yen. Okay, so let's quickly have a look at this one, shall we? CAD yen. Let's find CAD yen. Go and have a look at it. Okay, so we've got an alert for Cayenne for the bearish breaker on M15. So we'll pop over to here, have a look. So I'm having a look at this. So excuse the symbol changer. Here, let me get rid of that actually. Okay, so that's the breaker that we've just had the signal on. First thing I'm going to look at is I'm going to look left. That breaker, have we just swept something to the left that is interesting? Possibly we've swept the high there of yesterday's high, so might be a good trade idea. Price is coming down, but it is sitting here and consolidating at the moment. The RSI isn't in a particularly nice position. It's kind of, the breaker's happened as it's been at the 50 level and it's down at 32. When price gets down below this level, what we're tending to think, price is going to go back up. So we'd probably be looking for longs down in this area, and this has been a short signal. So for me, it's not a good trade idea. Shut the chart. Not interested. Okay, that's it. Analysis done. Right, on that particular signal, that was my analysis. I looked at the RSI and thought, don't fancy it. Shut the chart. Wait for the next alert to come up. Okay, so that is how I spot my entries. Literally, I'm sitting here watching Netflix, chatting to you lot on Telegram in the live room, and we're waiting basically for alerts to happen for us to go and do some chart analysis. Okay, so that is the key to my trading and how I trade. All right, so it's very simple. So what I'm going to do now is have a quick look at some strategies, some ideas for ways to get into trades. And we're going to look at some typical entry criteria that I take. All right, so it'll give you a bit more of an insight into when I'm doing my analysis, exactly what I'm seeing on the charts. Okay, so let's have a look at my first strategy. This is the H1 and H4 swing trade strategy. This is my bread and butter. I basically spend, bread and butter that should be. I basically spend most of my time looking at H1 and H4 charts, purely because these are the charts I find that give me the best entries and cut out a lot of the chop that you tend to find on M5 and M15. I tend to look at the M5 and M15s for scalps. So if there's not a lot going on and I want to get into trades, I tend to look at lower time frames for that. But we'll cover a scalping strategy in a minute, which I'll show you anyway. So the H1 and H4 swings are basically multi-day holds usually. Sometimes I hold them over the weekend, but I always try and avoid weekend holds if I can because of gapping. It's very rare these days that we get decent gaps that would really hurt you, but it does happen. So I always try and get flat if I can on a Friday, or at least minimize the amount of risk that I'm taking into the weekend. So the first rule is we need the TDI or the RSI on H1 or H4 to be either above the 68 level if we're going to be taking a short, or below the 32 level if we're going to be taking a long. Now if we get a signal to go long or short with the order block breaker indicator, it's okay if this if the RSI has just entered that level, or if it's just exited that level. The ideal is if it's exited that level with a shark fin, because that is indicative of a stop hunt, but we'll have a look at that on the chart in a minute so I can explain. Second rule is that we have a breaker on the lower time frame. If we've got a breaker, it's a trade. If not, I'm not getting in. So it's not just a case of looking at the RSI and waiting for the RSI to get below a level and just jumping into the market. We need a signal, and the order block breaker indicator is our signal indicator. So what I'm doing here really is using the dashboard for M15 breaker alerts, and when I get an M15 breaker, I'm having a look at the RSI level for H1 and H4 and just seeing if we are at a level that I'm interested in taking a trade from. Okay, so that's rule number 2. Rule number 3, have we recently swept a high and performed a stop hunt, or obviously low if we're under the 32 level and looking for longs? If not, is there a close area we can get to with our second entry that looks good for a stop hunt if we decide to get in on the first one? Okay, so if that next level is way too far away, I may not enter. So the key here is that we are looking for M15 breakers, but we're using the H1 and H4 RSI levels as the barometer, if you like, for whether or not we should be even looking at that signal. Okay, so let's take a look at the charts and have a look at some examples of these. So I've got a chart up here for the pound Swiss. This is just the most recent one, all right, and we're on the M15 time frame. So what I'm going to do is, when I see a breaker happening on the M15 time frame, so for example this one here, I'm going to mark it on the chart. I wouldn't have to do this obviously if I was on the hard right edge, but then I would switch up to the H1 time frame and just see what position the RSI is when that breaker occurs. All right. So what I'm looking for here is, when I get a breaker on M15, I want ideally to see a nice pattern here of a stop hunt on the M15 chart. All right. Let's just undo that and scroll forward a bit. So I've got a breaker. There's a good chance that we've just stop hunted this level. We have pushed up from Asia and put in a new high and pulled back, stop hunted that high as well. Okay, and then we've put in a lovely M pattern here, which is a good indication that a reversal is happening as well. Okay, and we've got our breaker. So that in itself, to me, on the M15 chart, says that looks like a good trade. But what I want to also see is, on H1, the RSI being in a level where we've had a strong push in one direction, and there is a high probability that we are going to be pushing back the other way. All right. So on my H1 chart, I want to see confluence. I want to see TDI over the 68 level, or has just pulled back from the 68 level. Okay, or it may have just pushed into the 68 level. You know, it could just push up into the 68 and then back down again. But I want to see price levels on the TDI or the RSI being up here. So I need confluence of that. A nice TDI confluence is obviously a big bonus. All right. And on my H1 chart, I want to see a recent stop hunt as well. So we've got a lovely level here where price has pushed up very hard, got to that level, it swept those highs, pulled back down. Okay. Now you see at this point, I haven't got a breaker on H1. 2 candles later on the H1, or 3 candles later on the H1, I've got a breaker on H1 as well, but I wouldn't have seen that at that point. But I can see that we've just performed a stop hunt of these recent highs. Okay, so those are the rules confirmed. All right, we can also use the H4. So if I see that the RSI has come down on H1, I might flick up to H4 and see where it is there as well. There's a lovely Batman there. You can see a Batman. This is a Batman pattern. It's another pattern which we're not going to cover, but yeah. So again, we're above the 68 level. Now, what you'll often find is, if H1 has had a strong push and is above the 68 level on the RSI, you'll find that H4 is also in a similar position. Okay, and M15. Yeah. So when we took this trade here, the M15 had just pushed above the 68 level as well, put in some divergence and pulled back down under the 68 level. So we've got lots and lots of confluence. All right. Now these trades I'm looking for as swing trades. So what I will be doing is setting my targets not on the M15 time frame. I'm trading on H1 typically, sometimes on H4, depending on where I see my targets. But on the H1 chart is typically where I will manage these trades. Now that's a key point that you need to understand. I am trading on H1, so this is my H1 and H4 swing trade strategy. This is my bread and butter, where I get a majority of my profit from, right? I'm trading on the H1 chart. I'm managing my trade on the H1 chart. I'm just looking for entries on M15 to get into my first position. Okay, so for example, I take this trade on this breakout. Oops, sorry, on the M15 chart. Okay, I take the trade on this breaker on the M15 chart. First thing I do, switch up to H1, and I look for, if I'm wrong, where's my second one? That's my second entry. Okay, obvious. If I'm wrong on this trade, what are they likely to do? Take price up, sweep these recent highs, and then bring it back down. So if I'm wrong on this entry, no drama, we'll just pull back, we'll take a second entry at these highs. So I'll place my pending there. Okay, I can't see anything else to the left here, obvious. So I'll switch up to H4, see if there's any other obvious levels. Okay, so what I could do here is possibly just this one to go up there, but in this case I'll probably leave it on the H1. Okay, so then we can scroll back and see where our third entry would be. So when I'm planning this trade, I would select that as my third entry. All right, and on this particular trade, because I've gone back quite a way, I've gone back to June, okay, on the H4 chart, that would be my trade plan for this swing. And what I'm looking for is for price to pull back down, and in this case, this propulsion candle here, I'm looking for this to be my target zone on H4. Or if I switch down to H1, we can refine that target zone to maybe there. Okay, the high of that candle, I would say here, would be that zone there is where I will be looking for price to come back down to. All right, and as you can see on the M15 chart, if we'd have taken that trade, it's well on its way to coming back down to that target zone. All right. So these are swings, as I say, these are multi-day holds typically. Now sometimes these will play out, because they're on the H1 chart, they will play out usually somewhere between 2 to 4 days, 2 to 5 days typically. But sometimes they will happen a lot quicker. Right? It all depends on what happens with news, where the propulsion candles are, how long ago these propulsion candles were put in. So you can see, for example, on this trade, this was Monday last week, so a week ago we put in this big up move. All right, now I could well have been selling. I could have sold on that candle there, got it wrong, sold on that candle there, got it wrong, come back up, sold on that candle there. I probably wouldn't have taken that because these would be too close together, but I'll probably be in 2 entries now and back down to break even on this one and taking a profit on that one. All right, if I'd have taken those trades. But you can see how long it takes. We've got 1 day, 2 days, 3 days, 4 days. We're on our 5th day now on this trade, and you can see prices now pushing back down. It's going to come back down into this area. So this is why these are multi-day holds. On H1, we've got our ADR, which is 121 pips. Okay, so realistically, we would only be looking for price to move around about that much on a daily basis. Okay, so from our trade entry, which is, switch down to M15, our trade entry, which is there, okay, we would realistically be looking for a 3-day move down to 3 times ADR push down to that area. Now that could take 3 days, 4 days, 5 days, but that's where I'm expecting. So you can see how realistic my target is. I'm only realistically targeting 2 and a bit ADR. I mean, this would be pushed up to that peak, but you see it's not a full 3 ADR move down. So that gives me lots of confidence in this trade, because I know that it's well within the range of the 3 times ADR push. We've got a lovely propulsion candle target. H1, we've got over the 68 level with some confluence, with divergence, which is absolutely fantastic. And the M15 entry has also been retested and dropped. So give me loads of reasons to get into this trade. Lovely M pattern at the top of M15, all right? So that's a good example of the H1 and H4 swing trades. So every time you see a breaker on M15, okay, have a look at the H1 chart see where the RSI is. If it's at a good level, investigate further. If it's bang in the middle of the range, scrap it and just ignore it and wait for the next signal to come along. Okay. So that's the first entry. That's the first system that I use to get into the market. Second one is the peak formation exhaustion trades. Now again, these are very similar to the previous trade entries in the fact that they are multi-day hold trades usually. Sometimes again over the weekend, but like I say, I try and avoid that if I can. These are taken off of the dashboard. So the first rule with the peak formation exhaustion trade is that the H1 peak formation high or peak formation low on the dash is showing as extended, i.e. the dashboard should have identified and alerted to a pair getting beyond its 3 times ADR level. All right. I've shown you the dashboard before, but basically we're looking at these columns here. Peak formation high and peak formation low. So if we've got a color block here, right, that's basically saying to me, start paying attention. So this pair has moved beyond its normal 3 times ADR move. Now there's nothing to say that this can't push on to 200% of its ADR. And in Euro New Zealand dollar last week, we saw exactly that. It's pulling back now. But typically we see this get somewhere between 100 to 150% before it gets completely exhausted and will tend to turn around the other way. So what I'm looking for is when I get an alert on the H1 peak formation high, I tend to just note it down and say, right, okay, this pair, I'm looking for a consolidation or possible reversal from now on. So I would be keeping this pair in mind and then waiting for an M15 breaker to occur. Okay, so the first rule is peak formation high alerts on your dash. So we've got an alert, we go and have a look at the pair and see what we like on that particular trade. Okay, the second rule is the TDI and the RSI H1 level again has to be above the 68 and below the 32 level. Now you're going to find that that will usually be the case, because if we've pushed hard past 3 times ADR and we're extended over the normal average daily range of that pair, you'll find that the RSI or the TDI naturally will have gone into that zone. All right, but what we're looking for is for that to have happened. So if we get a 3 times ADR push alert, peak formation high alert, and we see the RSI hanging around underneath the 68 or over the 32 level, it's probably not pushed hard enough. We're not going to get that elastic band effect to snap back. All right, so we're looking for those levels to be hit again. RSI is king. Okay, never trade without it. Rule 3, we're looking for a breaker on the lower time frame. So in a very similar way to the previous H1 swing trades, what we're looking for here is for peak formation to have kicked in, as well as the rules on the previous trade strategy. So we're going to have a look at an example now. So as you can see, we have got, for example, let's look at the Aussie dollar CAD. That's 122% at the moment. Aussie dollar CAD. All right. So let's clear the chart up a little bit. So basically, what the peak formation high or peak formation low column is saying in this case is that's 74 times ADR, 74 pips, which is ADR. We have moved more than 3 times ADR away from the most recent peak formation low. Okay, so that is the point where we would expect a consolidation to kick in and price to make a reversal. As you can see in this case, we've pushed further away from that level. So what I would be doing when I get this alert, and I would have received this alert probably around there on Wednesday initially, then it would have pulled back, pushed up. I would have received an alert again on that Thursday, pulled back, and then I would have received another alert today, on Friday on that, and again this morning. So what I'd be doing is sitting now on my M15 chart from Wednesday onwards. So from back here, you see where it pushed over the peak formation, the level that we've marked there, which is 3 times ADR. So I'd be looking at getting into entries here. All right. So on the H1, we weren't above the 68 level, not quite. We touched it, and we did get a pullback, but it's pulled back to the midline and it's kind of pushing back a little bit. So we could have taken an entry there on H1. Worst case scenario is we possibly could have grabbed 30 odd pips, but we probably would have kept hold of that because we'd be looking to target somewhere lower down. We would have got another alert here. You can see the RSI is not in the right zone. We would have got another alert on the Friday, and the RSI has recently peaked. So we probably would have taken a trade somewhere around there on a Friday, okay, when price pushed up. We would have had an order block there, which wasn't broken. That wasn't broken. So we wouldn't have actually had a signal, a breaker, on the Friday, unless we'd have taken this one. This possibly would have been a breaker here, so we may have got in on this candle here. And if we had, we'd obviously be setting further targets. But you can see what I'm looking for, okay? I'm looking on the H1 chart to make sure we've got the RSI over this level, or recently over it. This is one that I probably would have taken a trade on Friday, although I don't take trades typically on a Friday because I don't want to hold over the weekend. But you could have taken a trade there on a Friday on the M15 chart. If not, you would have looked for opportunities today. And today you would have found a breaker there. So that would have been the entry that you would have taken. Now I'm already in a Canadian pair, and I'm already in 2 New Zealand pairs. And the reason I'm not trading the Aussie at the moment is because I'm in New Zealand, and the New Zealand dollar and the Aussie dollar are very, very closely linked. So that's one of the reasons I haven't been looking at Aussie dollar trades today, because I'm already piled into New Zealand. So I'm not taking any trades on the Australasian currencies. As you'll know from the module that I spoke about previously with the correlation between the Aussie and the New Zealand dollar, we don't trade the Aussie dollar short and the New Zealand dollar short. It's the same thing basically, all right? Aussie dollar, US dollar, New Zealand dollar, US dollar, pretty much the same currency. So that's where you could have got in with a trade, okay? So you got to get on this breaker here, and on H1, when that breaker formed, you would have found that you just had a spike above the RSI on the previous Friday, divergence. So there's lots of correlation going on here for a possible short. But the reason behind the trade initially was that alert here on the Aussie dollar CAD, all right? Now, you could argue that you would have got an M15 breaker alert and looked at your H1 chart and done exactly the same sort of analysis as the previous H4 and H1 swing trades. And they are very, very similar strategies and entry rules, okay? But this is alerting from the peak formation high, peak formation low columns on the dashboard, right? So it's just another alert to say, come and have a look at the chart. Remember how important I've said over the modules chart time is. It's imperative you get chart time in, and analysing charts because you've seen these alerts is another great reason to do that. Right, so that's basically the peak formation exhaustion trades. Adr Reversal Scalps are the next strategy, and these are basically in and out within a few hours scalping trades, typically taken on lower time frames. What we're looking for and expecting here is a reversal after an aggressive move which takes price outside of its normal comfort zone, i.e. outside of its normal average daily range. The concept here is that price is reaching for a level to perform a stop hunt. Okay, so we're not looking for price getting outside of its ADR level by just grinding gradually and slowly to the levels, to the edges of the ADR and maybe hanging around there or pushing a little bit lower. We're looking for a strong price move outside of it and a ping back, an elastic band effect. We want price to be stretched, so it's reaching for a level before it's going to come back into its normal ADR, right? So rule number one is obviously the ADR has to be above or below its normal maximums. So we've obviously got the dashboard, which has the ADR column. So these trades are purely taken off of the ADR alerts. So when I get an alert on, for example, the pound Aussie and the pound New Zealand, that immediately prompts me to go and look at that pair. Okay, so I'll keep that pair up in another window on M5, and I will keep monitoring that to see what's happening. All right. Rule 2 is we need a reason to get into a trade when it's outside its ADR or it's at its ADR extreme. Okay, and that's going to take the form of either a breaker, a price action pattern, or an M or a W pattern. Okay, I'm going to show you these in a second. And what we're looking for is a reason for price to reverse back into its normal ADR level and to then consolidate for the rest of the day. So what's happening here is we've had the Asian range. Okay, let me just draw this. We've had the Asian range happening, all right, and we've had price push during London, typically, to its ADR level, all right? So that's its normal average daily range, say, okay? And it's pushed there during London. And what we're looking for is a reason for it to do something that will tell us it's going to ping back here and during New York, come back and sit in a normal level, ready to reset for the next Asian session, okay? So that's the concept. So what we need is at the extreme level of ADR to see price action, an M or W pattern or a breaker forming. Third rule, as always, we've got the RSI or the TDI being above or below our 68/32 levels, and this is on the M5 time frame now we're looking at. Or it has just pushed outside, so it's pushed into that level and we've got a nice pull back into normal levels from, say, from the 32. So we've gone below the 32 and we're back into the normal level. We've gone above the 68 and we've come back into the normal level. Okay, so let's have a quick look. Now on the charts at the moment, we've got the pound Aussie and the pound New Zealand. So let's have a quick look at that one. I've got this already marked up with a line for some reason. Obviously been looking at this previously.